Welcome back, and joining me for a closer look at what's played out on the market scene is Roy Mutooni from Sanlam Investments. Roy, thanks so much for your time today. Now, tensions in the Middle East under the spotlight and weighing on sentiment. It did seem like those gains in the oil price somewhat subsided. They didn't seem like they were holding. We saw, a pullback between Monday and Wednesday. But I see we're close to those Friday levels again. The last time I checked, Brent was above $76 per barrel. How concerned are you about, what's playing out there, the potential risks to the supply picture, and also just the US's involvement and how that could be a catalyst when it comes to tensions escalating?
Yeah, that's the question of the day, right? The thing about the oil price is the dynamics. There's multiple dynamics. The first thing is we're probably in an environment of oversupply and soft demand. So actually prices should be a whole lot lower. But then there's a geopolitical premium that's come through because of the risks that are emerging in the Middle East. And what are those risks specifically? It's a blockade of the Straits of Hormuz. The Straits of Hormuz represent maybe about 25 to 30% of all oil transported out of the Middle East. A blockade there creates a shock, without a doubt, and that impacts a whole lot more people than just the people in the Middle East or the US, for that matter. And I think that's what's causing all the vacillations. I think on Friday it was a shock. On Monday there was a feeling that actually it will just be restricted to the Middle East and you won't get an interruption in oil. And all the discussions were around not bombing oil supply or oil producing units and everything. So I think then the oil price started reacting to the supply demand balance. But now when you're seeing that the US might get involved, that Iran might decide to interfere with oil production, that some of the oil production units have been bombed, then the world starts asking, maybe there's a supply issue. So I think it's the level of uncertainty and the fact that it's so close to such an important arterial zone that you see all of this volatility. And the way it's pricing right now is an increase in the oil price, which tells you that the world is actually concerned.
Yeah, and a graph was put up there for oil, and I see it's back above the $78 mark. And that, of course, you mentioned that could spill over into inflation. And I can imagine that central bankers across the globe are really concerned. Yesterday, we had the Fed stand pat on rates. But policymakers now expect higher unemployment rates, slower growth, and higher inflation. Yes, they have alluded to the tariffs weighing on that inflation picture. But of course, I can imagine that oil price, the higher oil price, will also influence, the trajectory of global inflation as well.
So I think the confusing thing for policymakers is usually what you have is an oil shock.
Yeah.
So a big geopolitical event happens, the price spikes, comes down, and then continues. But right now what you're seeing is it spiked and continued up there. And where the inflation picture becomes complicated is if it's going to spike from the levels that it's at right now. That makes things absolutely worse. So that's the confusion they have, because you can definitely see growth slowing, and like Fed Chairman Powell said, as a result of lower trade and the tariffs, GDP growth is slowing.
Yes.
So it's a slow environment. It's not yet recessionary, but if growth is slowing, and you have oil prices that high, then growth is slowing and inflation is up. It makes it very difficult for them to use monetary policy as a way of managing the balance between slower growth and higher unemployment. So it's a very difficult time for them because the exogenous factors are quite significant.
So the main issue here is, if those gains hold, that's when we will start seeing, a lot of the risks then filtering through into, everyday factors, that including, of course, fuel prices as well.
Yes.
All right.
No, absolutely. That's the thing. So because if you compare, because inflation is about increase in prices.
Yes.
If this oil price holds up at this level relative to last year, and then that goes into the fuel price, then that now starts getting imputed into price calculations. And then also, more importantly, it influences what people expect. So inflation expectations rise, and usually it's a self-fulfilling prophecy. If we expect high inflation next year, then inflation will rise because we'll go out and buy all the things that we would have wanted because we're afraid of having to pay higher prices in the future.
Okay, let's look at some company news before we get away with ourselves with the oil price. Standard Bank out with an update today. Now, despite net interest margin slipping on the back of those rate cuts that have come through, the group still managing to post a 10% rise in HEPS for the first 5 months of its financial year. Just your assessment on that update, Roy.
So it's a solid update. Like they refer to it as resilient. I think the thing to take away from it is that lending's not growing. And that's a reflection of this economy. And it's a reflection of demand for credit here, that people aren't actually borrowing to invest or to consume. And that just tells you how difficult things are. But as a well-diversified financial institution, they're making money in different ways, and they've kept their return on equity at really good levels. I mean, the high teen levels is good for a bank like them, and I think it bodes well. They're an interesting hedge against volatility. They're nicely diversified, so you don't see aggressive growth there. You see defensive growth, and I think they're guiding to growing at about 10%. That's actually quite good for business that size in this environment.
All right, quickly before I let you go, what's your stock pick? Where are you seeing opportunity at the moment?
So it goes back to what you were talking about, inflation. My stock pick would be Premier Mills. So Premier is one of the biggest producers of bread. Currently, they produce bread and sell it in the coastal regions, and now they're coming into the inland. They're very low cost of production because they upgraded all of the equipment. They've done a lot of capex, and they continue to grow volumes, which is something you haven't seen with food producers recently. So I think despite the rally in the stock more recently, there's still more upside there. When their new factory gets finished inland, they should grab some market share, and that should support earnings growth into the medium term.
So Premier one to look out for. Roy, thanks so much for your time and taking us through trade this evening. That was Roy Mutooni from Sanlam Investments.